So welcome everybody. Thank you for joining. My name is James Moffat, and today I'm going to be talking about 9 things driving the price of cryptocurrency and one that isn't. So this is the second in a series of events we're hosting, designed to educate and inform you on the world of blockchain and cryptocurrency and try and break down some of those myths. The event today is brought to you by the Digital Future Fund and the New Future Foundation. The Digital Future Fund is an exclusive investment, learning and networking community for qualifying individuals looking to invest in high-tech alternative assets such as crypto. We run events like this, but also more intimate events that are invite only, which are more conversational in their form. We run dinners, guest speakers, and also trips around the world to visit many very exciting crypto and unicorn tech startups so that you can learn and invest in this space in confidence, and you can also invest with us. The New Future Foundation works with entrepreneurs and startups and established business leaders to help them make the most of the vast potential that technology offers to digital wealth creation in the next decade. The World Economic Forum states that 70% of the new value created in the 2020s will be delivered through platform business models. And our incubator and product innovation team work with technical founders and established businesses to build and launch sector-specific platform businesses that are highly scalable, taking them from an idea on a scrap of paper to market, to a tested project with go-to-market there. So that's the companies that are kind of supporting this chain of events. Those of you who find it interesting today, the next event coming up, the next date for your diary is on the 17th of November at 5 p.m. It's on CBDCs, or central bank digital currencies, the digital pound. Are you ready? And the host will be our guest, Johnny Fry from Team Blockchain. Now, you may be aware that Johnny was meant to be speaking today, and I've had to do a quick swap around in the last week because Johnny was actually invited to speak at the Parliamentary Select Committee today on cryptocurrency, advising the government on how to go about regulating cryptocurrency and dealing with it as a financial set of assets. So the quality and the caliber of speakers that we're getting is very high. And obviously we felt that it was important for him to prioritize that because it gave us an opportunity to support him in having an influence on the right direction for legislation in this space in the country. Just to kind of note, to make it absolutely clear that this webinar contains no financial advice. We're not a regulated financial organization. Crypto assets are highly volatile and unregulated. If you invest in them, you run the risk of losing all money invested. We're not giving financial advice. The information presented today is to help you understand something that is complex, challenging, and to give you an insight into what is actually going on and why. So to the 9 things that I think are driving cryptocurrency values and prices in 2021, and one that arguably isn't. I've put it together in this form. There's obviously more than 9, more than one that isn't, but it's just a fun way of bringing it down and kind of reminds me of the old top 10 countdowns on the music that I used to listen to when I was younger. So we're going to take that kind of approach to it, and we're going to rattle through at a rate of knots, covering quite a lot of information. So in at number 9, we have speed, scale, and maturity. So I've cheated on the first point, surprise, surprise, and put 3 points together in one. So it covers a multitude of sins, and they're related, but also different. The net impact is that most of the time they put a limit on the price growth and are holding back the price of crypto assets at this particular time. The first use case for cryptocurrency and for Bitcoin was as an alternative form of money to fiat money. The question I ask you is, would you wait 5 minutes in order to make a purchase in store? I'm sure the answer is probably not. And this is why transaction speeds for crypto remain a massive block to adoption. So Bitcoin credit cards, PayPal crypto purchases, DeFi apps, Ethereum, mainstream cryptocurrency adoption seems to be happening more and more, but there's still that missing piece of the puzzle, which is slow transaction speeds and a lack of scalability mean that it's unsuitable for day-to-day use most of the time. The issue with Bitcoin speed has actually seen its primary use case shift from being an alternative form to fiat currency to fundamentally a store of wealth, simply because the transactions are slow, and therefore it acts more like a long-term savings account or ISA or pension, where you would expect to wait days or weeks to be able to get your money out. There's also been an explosion in altcoins trying to deal with the limitations and kind of mistakes that as the first cryptocurrency, Bitcoin made. So, and the measure of speed, the measure of transaction speed is called TPS. Transactions per second. Now, Bitcoin comes in at about 7 transactions per second versus the Visa network, which is the most used payment network in the world, at 24,000 transactions per second. Now, many of these altcoins are challenging that. Polkadot, which is a fast growth altcoin, is producing around, or estimates to be able to do around 166,000 transactions per second. And some estimates say that it could do up to 1 million at scale when fully built. Polkadot does this using a technology called parallel transactions, which is kind of does what it says on the tin. It allows multiple transactions to happen at the same time rather than one at a time in a queue. Ethereum 2.0, Ethereum being the second largest in terms of market cap coin cryptocurrency out there. Ethereum 2.0 is a new version of Ethereum that is kind of on its way, kind of due now, kind of already here, maybe due in the new year. It's kind of evolving out over time. That promises or offers or threatens to do 100,000 transactions per second, which would drastically change the use case for Ethereum 2.0. So speed is a major issue in many real-world use cases, but not all. So in terms of stores of wealth and saving, low volumes of transaction speed isn't a barrier to entry. And all these different coins have different use cases and opportunities. The second part of this is scale. So just to talk about scale a bit, the market cap of all crypto is about 2.5 trillion globally, which sounds like a ludicrous, unimaginable amount of money. But it's still about only a few percent of the entire global GDP or market value. A key issue of scale not being there, or a lack of scale, is that it allows manipulation, market movements up and down into reaction by singular events or singular actors in the market. Now, in 2017, the Bitcoin price rose to 20,000 and later in that year fell back to around 9,000. It was a major kind of boom bubble moment in the crypto space. One analysis of this states that that cycle was actually kickstarted by Tether, USDT, which is a stable coin being launched without the actual dollars in it to back it. So the idea is that USDT has $1 for every kind of tether that there is. In practice, the suspect is that that wasn't the case, and people who got Tether were able to go buy huge amounts of Bitcoin without actually really having any real world money. And this is claimed accounted for about half the peak in value in that period. So half the increase in value. There obviously are other variety of factors. This was just the trigger. And that included a flurry of ICOs around that time, Bitcoin being part of PR and marketing tools, and consumer investors jumping on the back in terms of hype. But this was a key part in terms of scale, and shows how something with small scale, a singular event, can have a big impact. Excuse me. The second way in which scale can be limited is through hype and influencers and specific individuals having an impact. So the obvious use case of that is Elon Musk, who is infamous for driving the price of various cryptos with his tweets and opinions. It seems ludicrous on one level that one person's opinion can affect the price of an asset by millions and make it go up and down dramatically. But that is what happened when he tweeted about Bitcoin's environmental credentials, and about whether Tesla would or would not accept Bitcoin. The price surged up and down over a period of time in response to these. And the third way in which scale is an issue is that big whales, people who own a lot of Bitcoin, either because they've come in with a lot of capital, or more likely that they were very early adopters and got in with large numbers of Bitcoin very early, are able to work together either as individuals or together in groups to move the market and heavily influence price movement. And this is more of an issue in small altcoins. that are very small user bases and are very new, where these whales can drop in, cause a massive peak in price, drop out, and leave a lot of smaller investors with egg on their face. Now, this seems a big issue, but the truth is it's not just an issue for crypto. GameStop, which happened earlier in the year, which is a traditional share in the main markets, experienced a very similar event this year. Some of the facts and figures behind the whole GameStop event are really breathtaking. So the SEC says the number of people trading GameStop shares each day shot up to nearly 900,000 by January 27th. Now, that's the equivalent of the entire population of Liverpool trading in a single small American company. And GameStop shares traded up 1,400% from their average from 2020 before that. And the shares gained 2,700% from January 8th to 28th, and then collapsed back again. Now, this was characterized as a David versus Goliath moment, with the little people doing to Wall Street what hedge funds and financial industry has been doing to them, in time immemorial. And it fits into the ideological narrative that kind of entrenched in crypto that shows, a challenge to the new establishment and an argument that new asset classes and new decision makers can arguably do a better job of managing money and financial assets than the traditional ones. So how will this play out? Well, as more big companies and more big investors come into crypto, individuals like Musk and other manipulators will find it harder to move the market. They'll be supposed to have their influence, and their share of funds will be watered down. A key driver of that will be institutional investors such as funds. And in fact, in October, the first Bitcoin ETF was approved in the US this month and launched, and it's very much considered to be behind the gains in Bitcoin that we've seen in recent weeks. And 2021 can be characterized by a year of institutional inflows of money, and scale is only good for the future prospects of crypto as an asset class. The final point that kind of falls into this triumvirate is maturity. And this is more about what is a key feature of successful cryptocurrencies, and that is decentralization. So decentralization, if you don't know, means that there are lots of copies of the ledger and lots of people validating the transactions. Not one, there's thousands of different copies, and therefore it's harder to copy, it's harder to hack, and it's harder to fake or forge or manipulate. Now, if you have a lack of nodes or a lack of decentralization, then this attribute goes away and it undermines the strength and maturity of the cryptocurrency or the blockchain in question. And this is a major risk to the success of infrastructure for cryptos. Bitcoin at the moment has around 12,500 active nodes, and that's pretty steady at any one time, around 100,000 plus worldwide, but they're not all connected and available all of the time. It does go up and down. In the last month or so, it's gone up a bit, but it tends to remain pretty steady. The more nodes there are, bottom line is the more scale, the more robust, and the more trust and security is built into the tech stack. Ethereum has around 9,000 nodes, but there was actually, interestingly, a big fall in node numbers this year by about 3,000. In fact, in September, because of a bug in the software, in a software update. So the software that is used to manage the nodes was updated, and it essentially split the chain into two separate chains. Now, this kind of software update could be a major issue going forward, especially if miners and node managers aren't prepared to update or don't come forward and change their software. And it's something that needs to be thought about going forwards in terms of the maturity of cryptos in the future. So in summary, speed, scale, and maturity. Speed in terms of transactions per second, we need to be able to do more. Scale in terms of the influence of actors over a smaller market, and maturity in terms of the distribution in crypto are all factors that influence the price of crypto today and into the future. So number two is ideology. Fundamentally, cryptocurrency was born out of a crisis, the 2008 financial crisis, and therefore ideology is built into it. In fact, this headline that you see in front of you from 2009 Times newspaper is written into the first block of the Bitcoin cryptocurrency. Now, the goal of the people founding cryptocurrency was to cut out the banks and the middlemen who they saw as corrupt and unreliable, electing instead to create a more people-driven currency, to use technology to solve the problems that the founders of Bitcoin were ideologically and politically opposed to. And there's a long tail of ideology behind this. So crypto anarchism is a big movement that looks to deal with anonymity in the web and the ability to be tracked, freedom of speech and freedom of trade, and libertarian ideals about free market, individualism, autonomy are also tied up in values of the creation of cryptocurrency. So what we see with the development of cryptocurrencies and Bitcoin is closely related to people trying to solve what they see as fundamental problems in digital society and the digital economy. And there's this concept called hodlers or holders. And these people are people that hold on to their Bitcoin and their crypto, no matter what happens to the price, because they believe fundamentally that crypto and Bitcoin is going to change the nature of the world. And that means that, you know, it builds that there's a lot of people not trading out, not cashing in their profits, and that builds the price over time. Today, there's still a lot of ideological driven thinking around it, around anti-government control. When we were advertising and marketing what was to be today's talk and is now next month's about CBDCs or central bank digital currencies, there were a lot of comments from people who basically say, if a government is setting it up or a central bank is setting it up, it is totally against the spirit or nature of what cryptocurrency is. And people are very passionate about this, and it is a very divisive subject. The current debate, however, is more moved on to how successful cryptocurrencies have been in solving the challenge that they set out to solve. So the debate is divided essentially between crypto agnostics and crypto maximalists. You know, crypto agnostics, you know, believe that cryptocurrency, yes, there is a good argument to say that cryptocurrencies have a role to play and that currencies shouldn't be controlled by central banks and governments, or at least that there should be alternatives. But they disagree that actually cryptocurrencies that exist fundamentally achieve that. And, you know, I would say I fall a little bit into that more cynical camp, whereas maximalists believe that crypto does work, it is the answer, and it does fundamentally solve the problem. I think the risks are that, you know, you could be looking at essentially a circulation of elites. Elites are extraordinarily good over history at absorbing and adopting revolutionary change and bringing those people in and bringing those technologies in themselves. Also, I think technology, in my experience, rarely meets the hopes and ideals of the founders. You know, think about the internet and the hope behind that, and social media and the positivity about the democratization of media and some of the bads that have come out of that as it's matured. So I think that there are risks that a lot of the crypto technologies don't meet the ideals and solve the goals fully, certainly as they are, but they do offer an alternative. Fundamentally, though, ideology does drive price because people believe it will change the world and they hold on for that change to happen. So the next one in our list is real world connectivity. So real world connectivity kind of falls into two areas or two ways of manifesting. The first is the number of distributed apps or blockchain-based apps that are designed to fix real world problems. Now, the reality is with blockchain at the moment, most of the apps that are out there and most of the stuff that is building are building the crypto infrastructure itself. It is an ecosystem building itself. They're not really dealing with consumer problems or consumer needs most of the time. Overwhelmingly, the developers are working on projects that are part of the crypto ecosystem, such as exchanges, DeFi, new blockchains, NFT mints, marketplaces. And whilst there are real world applications in collectibles, gaming, you know, other financial services, real world applications, they're very kind of niche still at the moment. So, one limitation to the price of cryptocurrency is it's a world that's still building itself internally. I think the second is on the back of that there's a lot of technical and user experience barriers to accessing crypto. So, for example, going on an exchange can be really complicated. The language and the infrastructure is new with wallets, exchanges, coins, tokens. This is stuff we don't understand. It reminds me very much of when I got my first computer connected to the internet. And you dial up, and my mum would complain that I was using the telephone line, and you would dial up and you'd wait for it to dial up, and then you'd open your Netscape browser and you're like, wow, there's this whole world of content out there like GeoCities or chat rooms and things like this that was totally new. And it seemed exotic, but it also seemed kind of scary, and you didn't know if it was safe. And I think crypto has that about it. And this is why education is massively important. There's also a role in terms of user experience and product designers. So most crypto at the moment is built for developers by developers who can use and read code, which means that if you want to do it without using code, it can be very complicated. Product designers, will design stuff that is much more user-friendly. And there are exchanges like Coinbase and tools like that, which are super user-friendly and really easy to get into. But I think these new tools, these development of these new user experiences, and actually the development of real world applications, this is going to happen more and more over the next few years. And it's part of the reason we set up the Digital Future Fund, is to give people the opportunity to get into this in a safer and more secure environment. Another thing that will affect us all and create real world connectivity is the central bank digital currencies. Most banks are looking into and researching it. The European Central Bank and the Fed, they're talking about planning how it will look. And the ECB has even said that within 5 years, they would try and have, their first digital currency in place. So this is going to touch everybody. So the next trend driving the price and value of cryptocurrencies is environmental and social good, or environmental and social governance. Now, ESG is a bigger thing around more social environmental responsibility in society. It's a big overall global trend at the moment. And from a corporate perspective, it's related to having a positive, or at least a not negative impact on the wider world when driving profit. In cryptocurrency, it feeds in several ways. So the first is cryptocurrency is ideological. It is meant to be a force for positive social change, and it's a trustless system. It's decentralized. It looks to crowds rather than government. So inherently, it's got a social good there that it's trying to fix just by its very existence. And it's really trying to provide new and better ways of organizing and doing financial and legal assets and tasks. Now, most of the projects will have a strong mission. So there's one called Reserve Protocol, which is seeking to stamp out hyperinflation. And there are many others with similar kind of visions and plans ongoing as well. The second impact of ESG is on crypto itself. So one of the traditional massive criticisms, certainly last year, leveled at crypto was the environmental impact. And that is the amount of energy and the amount of electricity used to do transactions. So the University of Cambridge Bitcoin Electricity Consumption Index measures this. And at one point, Bitcoin's annual consumption was higher than the entire country of Argentina and the Netherlands. But it has come down massively since then. And in fact, there's been huge investment by the community in trying to come up with greener ways of producing the electricity, and lots of innovation in reducing power usage, block size, new forms of crypto, and new technology for mining, hardware for mining and managing. And this means the green credentials of crypto have massively improved, and they're going to continue to improve. And very quickly, in the very near future, crypto is going to be leading financial assets and financial markets in terms of its green and ethical credentials. A third characteristic of cryptos is that many of them are designed to seek to change the world for better directly. The reason they can do this is cryptos have incentives built into them, right? So if you do certain actions, you earn crypto tokens or coins that you can in theory exchange for services or for cash. Now, if we're going to change the world and change behaviors, having incentives is necessary to change behaviors, and they have them built in. So there's many ESG-driven cryptos, and the one you can see on the screen in front of you is Regen, which offers landowners tokens for managing their land in ways that maximize carbon sequestration. And they can sell those tokens to those who want to do carbon offsetting. But there's loads of others: Faircoin, Sea Token, trying to save the seas, Aquari.io, and the Happy Coin, which is dealing with mental health issues. Another key one is Brave Browser, which is a key ideal of crypto, which is that to keep people safe from their data being tracked and to control their privacy. Brave Browser is a web browser that replaces Chrome or Safari or whatever you use, that allows you to use the internet, but without being tracked. So in summary, ESG is intertwined with crypto and its value, and will remain so, simply because it is ideological in nature. ESG is driving the change and the eco standards within crypto, and cryptos specifically designed to deal with eco issues like saving the environment are being built all the time. The next trend driving value in cryptocurrency and prices in 2021 is DeFi, or Decentralized Finance. Now, this is an umbrella term for crypto and blockchain applications geared towards disrupting financial intermediaries. And it's part of the move towards a financial service industry built on blockchain. It's essentially finance that doesn't rely on central financial intermediaries such as brokerages, exchanges, or banks to offer traditional financial instruments and new ones, and instead utilizes smart contracts and blockchains. So how does it work? Well, typically, users engage with DeFi through, yet again, software called dApps, or decentralized apps, most of which, in terms of DeFi, are currently built on Ethereum. Now, unlike conventional banks, there's no applications to fill out, no central arbitrator that says you can or you cannot take part in this. And some of the ways that DeFi is used is it offers lending. So you can lend out your crypto and earn interest on it and rewards. And interestingly, you're paid by the minute, not every month or once a month. You can get loans, on the other hand, so you can go out and get loans without filling in the paperwork. And there's something called flash loans that have come along, which are extremely short-term loans that financial institutions simply can't offer. Trading tools for trading. So there's something called I can't remember what it's called, but it's a decentralized exchange that allows you to trade peer-to-peer with no centralized exchange out there. And there's many examples of that. They're harder to build than centralized exchanges, but they basically mean that you don't have an intermediary. And there's lots of other ways for saving for the future, buying derivatives, and other tools out there as well. So currently, DeFi, or decentralized finance tokens, have a market cap of around 173 billion US dollars and rising. And most of that has come in 2021, and they're rising at a phenomenal rate. So DeFi is certainly a characteristic of, the crypto world building itself, but it's a whole subset in its own right. Beyond Ethereum, there are other key technologies that are part of this. Tezos, Avalanche, and Chainlink are three examples. And some of the more popular applications include stable coins, lending platforms, and prediction markets. And there are some bizarre new financial instruments such as money Legos and liquidity mining and yield finding and things like that, that if I'm really honest, I don't understand what those are, because I'm not a financial advisor. But DeFi fundamentally is a fundamental feature of the crypto space, and a massive driver of value, and will continue to be for years to come. The next driver is Bitcoin. Bitcoin itself is a massive driver of the overall value of the crypto market, not least because it dominates the space. So Bitcoin dominance is a monitored measure in the market. And currently around 45% of the market is Bitcoin, essentially. Now, if you focus on just proof of work tokens, coins that intend to be money, like Bitcoin intended to be money, and not the ones that are applications, then it's nearer 65% of the market is dominated by Bitcoin. That's excluding stable coins and ICO. If you take out Ethereum as well, which is moving away from proof of work to proof of stake, the dominance rises to 93%. So overwhelmingly dominating the market. And in fact, out of the 2,800 altcoins tracked, 2,400 of them have a positive trading correlation with Bitcoin. Ethereum trades with Bitcoin 68% of the time, and Ripple over 30% of the time. So whilst the trend is declining as more coins launch and use cases vary, there is a decoupling, especially in bullish market conditions. Most of the time, Bitcoin is driving and leading in terms of the overall price of coins. That will change as more institutional money comes in, but that institutional money tends to go into Bitcoin first. And as I said, this ETF that launched in October, the price of Bitcoin has gone up, and now we're seeing a lot of altcoins kind of following on from that in a rally. And many suspect that that is linked to the launch of that ETF. So the next thing driving cryptocurrency prices is non-fungible tokens, or NFTs. Now, I get asked so many times about NFTs. Here's a fascinating fact for you. So the market value, the market cap of NFTs has gone from near zero to $5 billion US dollars, mostly in this year. But bear in mind that when we're talking about DeFi, we're talking about hundreds of billions of dollars, not 5 billion. So it's relatively small in compared to other asset types in terms of its overall market share, but is unbelievably where a lot of the hype is at the moment. Now, non-fungible tokens are a unique form of token that are not interchangeable. Most tokens that you'd be familiar with, like Bitcoin and Ethereum, they're just like money. You could change one for another. One £1 coin is worth the same as another, the same with one Ethereum versus another. But non-fungible tokens are completely unique. They're stored on a blockchain, just like a fungible token, but it's a one-of-a-kind record. A good way to think of it is like a certificate of authenticity, or a receipt of purchase, or even a digital proof of ownership. Now, it's very much derived out of the concept of smart contracts. It is essentially an electronic contract of ownership. And in the smart contract, it's written in it, it says what the thing is that you own, you know, what is it formed? So is it a digital asset? Is it an image? Is it a file? Is it a real thing? What the parameters are of it, of the ownership, and any value that's associated with it. So if it was bought, so literally it's like a receipt of ownership or proof of ownership. NFTs were first launched on Ethereum in 2015. The first one minted was called Avant la Lettre. It was actually in 2014 by Kevin McCoy. And then the first NFT project was called Ethereum and was launched just after that. And it's kind of like a little world, a set of blocks that you could buy, like digital land, and you could buy plots of this digital land. Most commonly, NFTs are still built on Ethereum, but also things like Flow, Tezos, and Solana. Most crypto frameworks, most of the good ones, allow NFTs to be built. On Ethereum, they have standards, so standard contract types that are specifically for NFTs. The two key standards are ERC721 and ERC115. So if you've got an NFT, chances are it's built on that. And NFTs, just like other tokens, can be traded on a market, just like any other asset. One interesting, unique factor about them is because they're linked to a central, often like a central thing, so a collectible or something like that, they have a centralized feature to them. So they have a point of failure or a centralized point of control. There's essentially two types of NFTs. So there's ones that have the blockchain built into the NFT that has the asset built into the NFT on the blockchain itself. Now that can be images or text, anything that is small enough, a digital thing, to be stored on the blockchain. An off-chain asset is something that either a digital asset that is linked to or a physical asset in the real world. One of the criticisms of this is that those links can get broken, or of course, you know, there is no actual physical link between the NFT and the physical thing in the world. And that is something that actually needs to be entrenched in law in order to be enforceable. And there is no law around that at the moment. So 2021 has definitely been the year of NFTs. That project I talked about, Ethereum, that was one of the first. It didn't sell at all until March 2021, when in a massive hype run on NFTs, all of the blocks that were originally available for 43 cents, sold for a total value of 1.4 million US dollars. There are loads of fun types of NFTs out there. So there are CryptoKitties launched in 2017, which are small kitten characters that can be collected. Jack Dorsey, the founder of Twitter, he turned his first tweet into an NFT and sold that for $2.5 million. And in fact, the source code for the World Wide Web, produced by Tim Berners-Lee, an NFT of that was sold for $5.4 million as well. So historical artifacts, things that might be in a museum in a digital context, can be wrapped in or linked to NFTs. What you can see on the screen is called Every Day's First 5,000 Days. It's a piece of artwork by Mark Winkelmann. It's the most expensive ever NFT, sold in March 2021 for 69.3 million, sold by Sotheby's. It's a picture taken every day for 5,000 days and stuck together. Mark Winkelmann has sold a number of others of these, and they are amongst some of the most expensive. So they appear several times in the top 10, top 20 most expensive. Another name that comes up a lot in the most expensive NFTs are CryptoPunks by Lava Labs. Now, these are little characters, again, like crypto kitties, but just little collectible kind of avatar characters. The most expensive of those have sold for 5 million, 7 million, 7 million, and 11 million US dollars, respectively. NFTs can be political. So an NFT artwork of Edward Snowden was sold to raise money for his activities for millions of dollars. And an NFT was created, which was essentially just a video for fundraising for a charity, and was bought for $5 million as well. The Doge meme, and we'll talk about Dogecoin in a minute, that was sold as an NFT, the actual Doge meme, for $4.4 million. So as you can see, there's a lot of hype, a lot of excitement about NFTs. They're a small part of the market, but people are very excited about them. But collectibles are everywhere, and they're part of our lives. Owning and collecting things and attributing value to them is as old as human society, and we've always been doing it. So they have a definite role to play in that. How to think about them now? Well, collectibles is a key thing, to think about in terms of where the market is. At the moment, the market is dominated by a land grab to become the primary issuers of NFTs. So there's more platforms being set up every day that allows you to create and issue NFTs. That's where the space is at the moment. I think the way to think about the future is to think about NFTs as a proof of digital ownership of digital and non-digital assets, and use cases beyond collectibles, digital art, historic objects, ticketing, smart tickets, in-game assets. So if you're buying games on Minecraft or assets, people will buy special assets that are built in the code. Virtual worlds. So there's a lot of hype around about the metaverse, which is really the VR version of the internet, which is coming down the line. Buying and selling and who owns things in that space could be dominated by NFTs. In music and film, one of the cool things that NFTs do for digital music and film is they bring back that scarcity. I remember going out and buying albums when I was young, and I'd buy 2 or 3 versions of it because there was a series of collector albums. You can't do that with downloads, but you can if you start to introduce NFTs that link things to it. There are as many uses as people want to buy different things out there. What NFTs do really well is they provide, in a digitally native way, the idea of scarcity of an asset. It overcomes that cut and paste, cut and paste, cut and paste. So it creates uniqueness and scarcity with an asset. There are blockers to NFTs out there. As I mentioned, there isn't any legal framework. It doesn't imbue you with any special rights, like, say, copyright, unless it's explicit in there. It gives you copyright. It doesn't give you any special rights. So that's all got to be challenged and worked out in the future. And fundamentally, NFTs are part of this bigger trend, this desire for scarcity of assets and to own things and for them to be unique. And a big driver of value, even beyond NFTs, I think, in cryptocurrencies will be this idea of digital scarcity. Ethereum, for example, is undergoing a change this year, EIP 1559, to make it more deflationary so that it becomes more scarce. rather than being an open-ended amount of Ethereum available. So the next one, and we're getting towards the end now, is regulation. Regulation is going to be a massive impactor on the value, growth or fall in the price of cryptocurrencies over time. Regulation is one of the biggest systemic risks to crypto, but is also needed to support mainstream adoption and to give confidence to institutional investment. The problem is it's hard to differentiate between different types of crypto assets, and the definitions are still developing. And issues include the fact that it's peer-to-peer, so it's not intermediated by an institution that can be the decision maker. It's pseudo-anonymous or totally anonymous, so there's no information about the people there. It has this irreversible transaction element to it. So there's, that means that if the law steps in, it's very hard to reverse or change or unfold an action that has happened. And transactions are immutable, so that, once you've bought or sold it, it's tracked on the ledger, which means the right to be forgotten, which is a fundamental right in most countries, in most democratic countries, and entrenched in law, is very hard to enforce. So there's so many different challenges there, not least that there's so many use cases for crypto, and it's very hard to work out what those are going to be in the future. In the early days of crypto, most of the concerns were around illicit activities and the use of crypto as a type of money. So money laundering, tax evasion, cross-border transactions, financial stability, a monetary policy. And while some legislation was put together around that, there's actually little regulation on them as a form of property or capital, or as a proper currency as well. And the reason for that is that, unlike other forms of financial assets, crypto assets can be both a form of property or capital and a form of currency at the same time. So it makes it very difficult because they both have very different legislative frameworks around them. And this has impacts on how you control tax, money laundering, and receipt of stolen goods. So what is regulated? Well, using currencies to make purchases is not regulated, but mining is regulated. So in China, there was recently a big change on that. Essentially a ban came in. But today, most jurisdictions just haven't taken a view on how to regulate crypto, and they're still working on it now. Part of the problem is because cryptocurrencies aren't geographically precise, it's not clear which regulatory body should be making a decision. So the way that most governments deal with it is that they regulate the point of exchange between fiat currency, traditional money, and cryptocurrency, so money in and out of the system, so buying, selling, issuing, and purchasing. And the areas that fall under this regulation are crypto exchanges, wallets, issuers, and kind of administrators. So it's really about controlling that money in and money out. And a big focus is on exchanges over other forms of activity. And when you're going into an exchange, you will be required to do anti-money laundering and know your customer stuff. So you'll be able to show proof of who you are, and often proof of funds, so that as you enter that ecosystem, it can be tracked. Governments like centralized exchanges because they've got servers in a geographical location that can be shut down or raided. Obviously, on the other hand of that, they can be hacked as well and manipulated. So, what is good for governments and control are arguably bad for having a secure crypto ecosystem at the same time. So it's an incredibly complex area. Combating terrorism is another area where it's been heavily regulated. And, the American Financial Crimes Enforcement Network, alongside, the Financial Action Task Force, the ECB in Europe, and other organizations are all coming up with different views and regulations on it. Just this week, the Australian subcommittee on financial technology and regulatory technologies identified 8 issues that they aim to address in Australia in this regulatory area. And they were surprisingly positive and progressive. And I only hope that, the UK government can take such a positive view and a progressive view on that over time. My view, regulation is coming in, and it will be the major driver of volatility in the system over the next few years. rules that go for and go against different currencies. Case law will cause different coins and cryptos to go up and down in value, some to succeed and some will fail. The challenge is, this is a global challenge, not a country-specific challenge. What I'd love to see is a global DAO, or distributed autonomous organization, which is a form of crypto organization for making decisions, to come together with all the national bodies and regulators to set a global framework. I think the chances of that are slim. Countries cooperating is often a challenge, but you never know, maybe in the future is certainly the best solution. And we get to the ninth thing that I think is driving values of cryptocurrency and prices today and into the future, and that is hype. Hype is arguably by far and away the biggest driver of value in the crypto space and currency prices right now. From stories of buying pizzas, for coins that are now worth millions, to people become billionaires overnight. There are so many myths and stories, and everyone knows someone who knows someone who knows someone who's made a massive windfall out of nothing. So much of it is gossip and rumor, gold-plated streets of the future. And arguably, there's a lot of fraud and nonsense in there as well. Talking about fraud, people come in and they take advantage of this hype. One of the best cases and examples of that was covered by the BBC in a podcast called The Cryptocurrency Queen. And it was about Rugia Inagnavota, who founded a Ponzi scheme called OneCoin. The scheme brought in $4 billion worldwide of income. And people, even today, the most vulnerable people in the world are still being encouraged to put money into it, even though essentially it's been shot down. And it essentially was a Ponzi scheme. It called itself a centralized cryptocurrency, which, if you've been to this event and the previous one, hopefully is a nonsense. Being decentralized is a key feature of cryptocurrency. This does two things. I think it tarnishes the legitimate tech and legitimate uses, but it also highlights the need for regulation going forward. I think another thing is that there's a fine line between failed ICOs and fraudulent ICOs, failed coins and fraudulent coins. Both start with an idea, both have lots of money to back them, both have to use that money to deliver a business and a platform against their promises that they've made. I think the fundamental difference is some have the intention of doing that and just fail. These are the legitimate ones, and then some have no intention at all and just want to take the money. The problem is working out which is fundamentally very difficult and very hard to make. A great example of hype, and not fraud, but hype, is Dogecoin, which you can see on your screen in front of you. So Dogecoin was created by software engineers Billy Marcus and Jackson Palmer in 2013 as a joke. So it was created as a joke, making fun out of the speculation and craziness in the cryptocurrency market at the time. That joke now has a market cap, get this, of $31 billion as of today. And it just was a joke. At its height, it had a market cap of $85 billion. And incredibly, there is now a use case for Dogecoin, right? So, and that is for online tipping. So it's used on platforms like Twitch and Reddit to tip content creators by audiences who appreciate the content that they've created. Now, Musk again has been involved in hyping this up, talking about it and driving the value up and down. I think what this highlights is a really interesting case, is that hype might start out as nonsense, but it can turn into real world value over time. It's not a sustainable basis on which to invest, but if there's enough hype behind something and it's got enough money and enough runway and the right people get involved, it can become something with a sustainable use case. Now, I don't hold Dogecoin, and I probably never will. But that doesn't mean it doesn't have a valid use case and it won't in the future have value. I think hype can't simply just be considered a bad thing. What is important is to understand what is driving that hype and where this hype might lead and why it is there. So those are 9 things that I think are driving the value of cryptocurrencies. I did promise you one that isn't. And that one that isn't is fundamentals. actually the fundamental credibility and the value of the coins and the assets underlying. Now, that isn't ultimately true, but if you think about it, 1 in 5 people in the UK, that isn't always true, but 1 in 5 people in the UK own some crypto, have bought some crypto. 99% of people don't have a clue beyond maybe an idea that it's an ideological alternative form of money to government controlled money. You know, they simply don't understand what it is or what, and they're certainly not asking questions like, what's the difference between ETH and Bitcoin? You know, what is happening internally? How distributed are they? How fast they are? What's the tech capable of? What are the real world use cases? How secure and robust are they? How well funded are they? You know, if you understand these tech fundamentals, the applications and the consumer need, crypto has the opportunity to deliver genuine value over the long time, but they remain highly complex, highly immature. And that's part of the goal for the Digital Future Fund, right? And why we're doing these events, to offer learning and investment opportunities and tools and information that bust some of the hype and the myths and give you access to fundamentals over time. So I've been James Moffat. Those are the 9 things I think are driving cryptocurrency values in 2021, and one thing that I think very sadly isn't. Just to remind you again, if you enjoyed that, our next event is on the 17th of October at 5 p.m. and Johnny Fry will be talking about the digital pound, CBDCs. Are you ready for those? Please sign up today. Tell other people if you're liking it. If you want to get involved in more in-depth events, if you want to think about, you know, learning more, having Q&A sessions or discussions, to go on trips and to meet other people that are interested, go and sign up for the Digital Future Fund. Sign up for the New Future Foundation to get on a newsletter and hear about free events. Thank you for listening to what we've been talking about. If there are any questions, I will endeavor to answer them as best I can. I can't promise I know all the answers, but yeah, please let me know.
We do have a few questions. Do you want to go through them now?
Yeah, go for it.
So one from Frederick is, what can you tell us about the cryptocurrency cycles, bull/bear markets? Are they going to soften eventually?
I can only give you my opinion, which is, you know, as much guesswork and telling the future as getting a crystal ball. You might get just a good answer out of flipping a coin. I don't know. My belief is that we're in for, you know, the term I kind of use is a bubble bath, right? Of big hikes in value, followed by regulatory impacts or big hacks or issues like that, and then drops in value, and then a period of stability, and then another hike, and you'll see incremental value increase over time. Most of that being driven by legislation, but also other things driving that as well. So I think that is a cycle. I think Bitcoin will continue to lead. And altcoins will follow, although, you know, with some of the things going on with Ethereum and other things, that might change. Who knows? You know, it remains to be seen. That's my view. But I think it will, you know, a period over the next few years of, by crypto standards, kind of mini booms and busts as new regulations come in, countries change their regulations, assets are defined, some assets win and others lose. You know, in terms of the cycle, I would look back to what happened in the dot-com boom and things like that, and say, you know, there will be a thinning out of the applications involved as well at some point, and then a whole new generation of use cases and technologies will come in.
Another one from Frederick is, how can we find out about fraudulent ICOs?
There is a website list, which I can provide with you afterwards, Frederick. We'll dig out a link, Charlie, and send that to you, which lists fraudulent ICOs that have gone on in the past. In terms of working out whether new ones are fraudulent, you know, your bet is as good as the last person who wrote the white paper or looked at the people involved. I think the people involved are a critical marker of that. Do they have a track record? But, you know, we'll dig that list out for you.
And what is the Shiba Inu use case?
That's a good question. I don't know. I need to have a look at it and let you know. It's on the side of the market, I suppose, that I'm less interested in. So it's something, you know, that I can find out about and go tell you. But if I'm totally honest, it's not something that really piques my interest. Maybe the answer is that there isn't one, but let's find out. We'll go away and find out for you. Come back.
We have 3 questions from Chris. I'll break them down for you. The first one is, what are your thoughts on the Lightning Network and its transaction speed?
Yeah, they're promising insane transaction speeds. There's a lot of coins in that space that are making big promises. So we'll have to wait and see, I think, is the simple answer at this stage. There are others that I personally have more confidence in, but that's again just my personal opinion. So.
Chris's second question is, what are your thoughts on NFTs being used in the gaming world to allow for the ownership and transferability of digital assets?
I think that's massive. If I could start a business doing that tomorrow, I would. I think there's so much of the world in the next decade is going to happen in the digital space. Like, if you're a little bit older and grayer and slightly bolder like I am, you don't notice it, but there are communities who live virtually entirely online in their life, in worlds like Minecraft and many thousand EVE Online and things like that, and they're transacting things, they're buying things with real world money. My kids ask me all the time to buy them things in some of the games that they're playing, and they're like 8 and 10, and they're doing transactions within those. So I think without a doubt NFTs have a massive role to play in turning those into more credibly and trustworthy assets that can be, identified as individual with a good kind of credible information behind them.
Thirdly, you mentioned that 1 in 5 people in the UK own cryptos. Please, can you reference where you got that stat from?
I will find out. Yeah, I will. I can't remember off the top of my head, but I will find out and I'll send you that link without a doubt.
And Frederick has asked, do you not talk too much about smart contracts?
Yeah, so I think, smart contracts for me are inherently, so there are cryptos that are there to be kind of money. And then there are cryptos that are like operating systems to build software on top of. And all of those, to some extent, kind of smart contracts or variations in smart contract are a key part of that. I think they are a fundamental, I think my personal view is that contracts, receipts and bills, anything in terms of a legal document, anything in terms of proof of ownership, and other forms of financial assets in the future will all be wrapped in some form of smart contract, right? And Ethereum and the ERC standards are leading in that space right now. That's just the facts. That's my personal view. I think it's fundamental to the most exciting. Smart contracts are fundamental to the most exciting and interesting use cases for crypto, in my opinion.
I think that's all the questions we've had so far. Anyone else have any questions they'd like to put to James? Oh. What is your take on NFTs in football clubs?
Oh, well, NFTs in football clubs. Well, football fans, they collect football stuff. So I think that's key. I think there's a great use case there for anything like that, that's got a fan base. That people want to have a sense of ownership of or collect memorabilia and stuff like that. I think the use of smart tickets, NFTs are smart tickets for different types of club members. So maybe, maybe you can have NFTs that give you access to certain games or on certain days or access to certain bits of media. I think there are massive use cases there. I think my favorite use case for football clubs, the big problem with money in football is that it takes away the connection to some extent between the football club and the community on which it was founded, as the big money comes in. I think creating, coins, football club coins, right? So that people who are fans can buy into, pool their value and potentially own some or all of their football club I'm convinced that will happen at some point. I'd love to see it happen in reaction to, say, Imagine if there was a Man United crypto coin by the Man United Supporters Club in reaction to frustration with the Glazers or something like that. I'm convinced that'll happen at some point. I'd love to see it happen.
I hope that answered all of your questions. James, there's no more coming through, so
that's good because my voice is falling apart. Thank you, everybody. I just want to say thank you for joining. I hope you find it interesting and enjoyable. I'd love to see you at the next event on the 17th of November, and we'd love for you to keep in touch. Do get in contact. We'll follow up on the questions we haven't answered, and we look forward to seeing you more at the next event and other events in the future. Goodbye. Cheers.